Like most conventional assets are hovering around record highs right now, despite all the headwinds in the market, from inflation heating up again to lingering uncertainty around tariffs to geopolitical tensions rising around the world to a weakening labor market. We've had weaker and weaker job reports after the last 4 or 5 months. So let's dive into a few of these conventional assets, why there's concern about a bubble in a lot of them, and then we're going to highlight one asset that is very obviously not in a bubble, and why Denny and I are continuing to invest in it. Stocks, first and foremost. S&P 500 up almost 20% over the last 12 months, 18.6% over the last year that it's up. As of the time that we're recording this in early November, it hit a record high just a few days ago in late October. Hit a record high of around 68.90. And, that's, again, in spite of all of these other economic headwinds and geopolitical concerns. So there are very real concerns that the stock market is in a bubble. And in particular, big tech stocks, which have driven the huge bulk of those stock market gains over the last couple of years. There's a lot of talk and a lot of concern about AI bubbles. Nvidia is sort of the poster child example of this. Its stock is up around 416% over the last 2 years, which is just crazy.
Do you think fear also plays into this?
Yeah, I mean, so people will talk about fear and greed being, there's sort of tug of war that go through investors' minds. But to your point, greed is also tied to fear, the fear of missing out, right? So you end up with this like pile on effect when one sector, one stock gains a ton of momentum and just seems unstoppable. And of course, the top of the market is the worst time to invest in any market, right? Whether we're talking stocks, real estate, gold, whatever. And then the bottom of the market, when everyone's freaking out and panicking, that's the best time to invest. But no one wants to do it because there's so much fear out there. There's everybody's panicking and there's blood in the streets, as they say. So
Right. Sell-offs, which
right. So you end up with the sort of irrational exuberance driving prices way up higher than they should be, creating a bubble in some cases, and then crashing and overcorrecting way further down than they should be as well. We don't believe in timing the market in the co-investing club, but those market bottoms when everyone else is freaking out and panicking, that actually is a good time to buy. So yeah, Nvidia up 416% over the last 2 years, just nuts. And so there's very real concern that AI is in a bubble, and it is fueling some of that concern are these circular deals among some of these big tech companies where, a company will say, we're going to, buy X billions of dollars in chips from Nvidia over the next 5 years or whatever. And then Nvidia will turn around and say, yeah, and we're also investing X billions of dollars in that same company over the next 5 years. So it feels very circular, right? It feels like there's some risk of there not being substance there, or if one thing derails one of those companies, that derails the entire thing, right? And the whole axis gets thrown off kilter. So yeah, there's a lot of real concern. What's that, Danny?
talk about gambling. Might be better to
Yeah.
go to the casino. Just kidding.
Well, it does feel speculative, especially since there are some real concerns about just how much productivity AI is adding to people who are buying this as a service, right? So yes, chip makers like Nvidia are seeing huge sales numbers and huge revenue numbers, but the clients, people who are, corporations who are buying AI tools and services, the last data that I saw was basically saying that that is as net neutral so far, that there is actually zero gain in productivity among corporate clients for AI tools because it's just not that good yet. And so people talk about AI slop and how coworkers are being handed these reports that basically have to be redone because they were all just generated by AI and they're all junk. They're total slop. So, we haven't actually seen that real meat and potatoes productivity gain from AI yet. Now, I feel like that's probably inevitable, right? We will see that eventually, but that doesn't mean it's here now. And again, that fuels concerns about an AI-driven bubble. And again, we're not saying that there is an AI bubble. We're just saying that there are legitimate concerns about one arising. Let's talk gold. Gold also up, way past record highs. So up over 102% over the last 2 years, which is more than doubling its previous record from a couple years ago. It was at record highs before that and has just exploded in value over the last 2 years. Yeah, as a hedge against some of these other risks that we're talking about, geopolitical risk, tariff risk and inflation risk and all of these other very real risks. A lot of money has flowed into gold, as a hedge. But now that too looks like it might be in a bubble, right? Especially because gold itself is speculative as well. It does not have any intrinsic value, right? It doesn't generate revenue the way that, say, real estate does or a corporation does. Right? You can measure the value of those things by the revenue that they produce. So, a corporation, you can look at price to earnings ratios and get a sense for, what is the true or the fair market value of this company. Same thing with a single family rental property or a multifamily property. You can measure its intrinsic value based on the revenue that it generates, right? Through cap rates and other metrics. So, speaking of real estate, home prices, there's also been some concern that they are overvalued right now. They are hovering around record highs as well, despite some weakness in the housing market. So according to Zillow, median home,
In
what's
the
that saying?
market, they're starting to drop big time.
Yeah, and that's the case in a lot of markets around the country. Nationwide, the median is 364,000 according to Zillow, which is hovering around its all-time high of 366,000 earlier this year. Home prices are also hovering in that all-time high range, even though there is some real weakness in a lot of housing markets around the country. Inflation has surpassed incomes for a lot of Americans, maybe even most Americans. So, we're seeing a lot of new supply hitting the market for homes, for single family homes.
Sitting?
Yeah, and sitting a lot longer. So inventory is up, it's sitting longer, and home prices have declined in a lot of markets. But there is a lot of that concern about maybe not a bubble is probably too strong of a word for home prices, but a correction. I think a lot of people are talking about a correction in home prices. So, what asset class isn't in a bubble? All right, we're going to talk multifamily because multifamily, they had their bubble a couple years ago. They had their bubble over 3 years ago. So we know that because it popped. So we were looking at the Federal Reserve data on multifamily real estate apartment price index. If you want to look this up, and we'll actually include that link as well in the show notes, along with a couple other reference links to what we've been talking about. It hit a peak, a record high in the second quarter of 2022. And if you remember, this is when the Federal Reserve was cranking interest rates through the roof because inflation was soaring at the time. So they had to raise interest rates very high, very fast to combat that high inflation. Now, over the next 2 years, from the second quarter of 2022 to the second quarter of 2024, that apartment index drops by 25.2%, which is a massive crash, right? I mean, that's a bear market for apartments, for multifamily properties. I mean, that is how much single family homes fell in the Great Recession, in the Great Financial Crisis in 2008. From peak to trough, single family homes fell between 25 and 30% in typical markets around the US. So, but wouldn't you love to be able to go back and buy single family homes at those prices, after they fell by 25%? Yeah, we all would, of course.
Yeah.
And that was what happened in multifamily, but no one really talked about it, at least outside of the niche multifamily investing circles, because the average investor isn't out there owning apartment buildings, right? But this is a huge opportunity. And sure enough, in the year from the second quarter of 2024, when it hit that low, to the second quarter of 2025, which is the most recent data we have available from the Federal Reserve, they did gradually recover 5.5% from that low. So it is rising again. And that makes us feel good as multifamily investors ourselves. I mean, so the Co-Investing Club, we don't just invest in multifamily, but it is one of the many things that we do invest in. We meet every month and we vet a new passive real estate investment together as a club. And we hop on a Zoom call and we have 40, 50, 60 of us evaluating risk. Sometimes it's multifamily property syndications, which is basically just a passive investment in a multifamily property. Sometimes it's industrial properties or raw land or mobile home parks, or it could be a note, a fixed interest note, or a private partnership with a flipper or a construction developer or something else. But the point is, multifamily already had its bubble, and that bubble popped. So that make me confident that now is actually a pretty good time to invest in multifamily properties. it's not a great time to sell multifamily properties, but it's a great time to buy and invest in multifamily properties. Interest rates and cap rates have stayed elevated for a lot longer than most investors were expecting, and it has led to a lot of distressed assets. So you can still, pick up these properties, or not you personally. I mean, most of us are not actually buying properties ourselves, but syndicators, sponsors, GPs, they're out there buying properties at a deep discount, especially distressed assets right now, because they are still recovering from that bubble bursting. We're still near that low. So it's actually a pretty good time to invest in multifamily. We feel pretty good about
Can you say this? Like, how long do you think when somebody invests in that, how long? I know we're not supposed to time the market, but just in your
it.
opinion, how long do you think you would have to hold something like that?
Well, so typical multifamily syndications, they last around 5 years. But that the reason that it's not set in stone, the way that like fund um funds will have like a mandatory hold period that's like very rigid. Syndications, the operator wants to leave themselves flexibility to sell or refinance when the market is better, rather than being forced into selling if it's a bad market. So, maybe the market in 3 years from now will be great and they'll sell in 3 years. Or maybe, 4 or 5 years will come along, doesn't feel like a great market for selling. So they'll hold it for an extra year or two, and wait for, lower cap rates and, therefore higher property values to sell. Yeah, rule of thumb in general, around 5 year hold is what's typical for these syndication investments. But that's not locked in place. It's not written in stone. You want to leave the operator some room to be flexible and to sell when it's a good market for selling, to deliver the best returns for all of us as passive investors in these properties.
And
Yeah, yeah,
and
go
it,
ahead.
I mean, I'm not trying to push our club, but I like the fact that we can go in with as little as $5,000 because you can spread it and it decreases risk. And I personally believe apartment communities are always going to be needed.
No
Period.
question. Yeah, I mean, housing is a need, right? It's not a want; it's a need. Everybody needs house, and there was a supply glut, and that's something that maybe we should have covered. There was a supply glut in a lot of markets of multifamily rental properties, rental units, especially in the Sun Belt over the last couple of years. That supply glut is over the next year. There's a crash of new supply hitting the market because there was, again, there was a bubble, a few years back, and it takes time for those construction projects to come. It takes years for them to finish. So all those projects that were started 3 4 years ago, they all hit the market over the last year 2 years, and now supply is drying up. So there has been some absorption of new units has been slow over the last 2 years for multifamily in a lot of markets around the US. Now that's speeding up again because that supply glut has ended, and new supply hitting the market is going to be much, much slower than it was. Yeah, dropping just dramatically. New units hitting the market from, a year ago versus today versus a year from now. There's a steep decline in that. Yeah, Denny, anything else you want to cover before we call? Oh, and actually, yeah, I just want to expand on your point. You brought up a really good point about investing smaller amounts across more deals. Multifamily syndications and, private equity real estate investments in general have historically been the playground of the wealthy over the last 100 years, with a minimum investment of 50 grand or 100 grand, or sometimes we've seen deals with a $250,000 minimum investment. In fact, the investment that we are looking at this month in the co-investing club has a minimum investment of $240,000. Yeah, it's really hard to diversify, especially if you're a middle class earner. If you have to put 50 grand or 100 grand out of pop in a real estate investment, which is why we don't, right? That is why we get together as an investment club and we all merge our money under one joint LLC and we invest together. So each person can invest with 5 grand or more, which is not trivial, of course, but it's also not 50 or 100 grand, right? Anyway, Denny, anything you want to add before we call this episode complete?
No, thanks for sharing all that, Brian.
Yeah. All right, guys, if you got something out of this episode, please share it with friends, family members, colleagues, neighbors, whatever. Subscribe, follow, like the show, Bucks Outside the Box. And if you're new to the idea of passive real estate investing, because this is new for a lot of people, we have a free course on how it works and 5 different passive investments, types of passive investments that we have invested in. Sparkfunnel.com/free for that free course. It's 8 episodes. They're all super quick, like 5 to 10 minutes a piece. So very snackable. And on that note, stay weird, unconventional investor.